Hello and welcome to Mortgage Watch, bringing you real estate, financial, and mortgage news that you can use. I'm Elon Auerbach, Vice President of Unitrust Mortgage in San Diego. A lot of homeowners have been receiving notices about their HELOCs being frozen. This is something that's been going on for several months, and we've talked about it previously, but it seems to be another wave of these freezes that are coming, and many homeowners are unprepared, even though we've been talking about it and it's been in the news for quite some time. There are steps that you can take as a homeowner if your HELOC has been frozen by your lender. What we're going to do is put on a special teleconference next week. We will upload it to our website and to YouTube as this teleconference is. And we'll also be sending out an email to those of us on our email list. It'll probably be on Tuesday afternoon, and then we'll address the issues and what the individual homeowner can do to get their HELOC restored and freed up. Earlier this week, Fed Chairman Ben Bernanke signaled that the Fed was probably not going to be lowering interest rates anymore because of inflation concerns. As we had said last week, with oil prices and commodity prices where they are, it's going to be very tough for the Fed to lower interest rates, although they would like to, because it seems that the housing market is showing some signs of stability, but lowering rates would definitely help keep everything moving. There is news, again, that the Fed is investigating how the oil futures market is operating. So the announcement is there's a bubble in that. Of course, we always poo-pooed the housing bubble, and now, of course, we're seeing that it wasn't quite so much of an extremist view and that there was really a lot of speculation and froth built into the housing market. For sure, it's there in the oil and commodities markets because they're traded, in stock markets. So we will see what that brings, and if those things can quiet down, then perhaps the Fed will be able to lower interest rates a little further and stimulate the housing recovery that we're all looking for. In other news this week, the Massachusetts Attorney General indicted Option One. They are, of course, owned by H&R Block, although they're in the process of trying to sell them, with charging higher loan fees to minorities. And they have several cases where, with identical credit scores and situations, minorities were charged higher prices. And we'll see how that plays out. Local banks are getting a lot more market share because it seems a lot of other mortgage originators have left the industry. It's estimated that previously there were about 55,000 mortgage brokers nationwide, and now there are no more than 30,000, which is to be expected. But that's half. And there's more regulation coming that's going to make it very hard for mortgage brokers to operate, as we've been predicting for a while. So local banks are starting to see more residential loan origination. In many cases, they are brokering those loans to the same lenders and institutions and bankers they were working with before, but they're considered to be more stable partners than your average mortgage broker. There is a refi package on the books for GMAC. GMAC, as you know, is the mortgage division of General Motors. And so General Motors' troubles have trickled down to GMAC, which has its own problems with the housing market. So they are desperately trying to raise cash. Of course, half of that company was sold earlier last year to Cerebus, who's a private equity firm. So we'll see how that plays out, and hopefully they will remain a player in the marketplace. For local banks, in addition to the good news that they're picking up, market share and doing more residential originations, more bad news, which we've been talking about for a while. The federal regulators have been focusing on the mortgage investment banks off of Wall Street, and also the large depository banks that have worldwide impact. But now their focus is shifting to local, regional, community banks, which have a lot of troubled loans on their books. These loans don't show up as securitizations where most residential mortgages do. So the trouble with them is a little slower to come to the surface, but with the slowing economy and the slowing market, most construction and development has just ground to a halt, except for the very best projects. That means that local banks have a lot of losses that they're not really ready to disclose. They're going to be coming, and that's probably going to be the last piece of solving this credit market and what's going to go on. Foreclosures, unfortunately, are growing, and that's one reason the Fed desperately needs to try and lower interest rates to keep stimulating, number one, interest in buying those houses, but two, perhaps keeping people from going into foreclosure by keeping their rate a little bit lower. As far as what the next week will bring, we expect interest rates to remain stable. We're looking to see what news comes out from the oil bubble, etc. There are signs that the housing market is firming up in places. A lot of lenders who own real estate property are really starting to mark that property down, and that's adding to a lot of activity. So again, if you're looking to buy a house, It is a good time to be out there looking, get pre-qualified. If you're thinking of refinancing or purchasing a home, you always want to deal with a reputable firm, someone you know, because this is a major, major decision in your life. If you're a business person, we look for commercial real estate to remain steady. There may be a few hiccups as the country goes through the recession, mild though it may be, and we deal with what we're going to do with higher gas prices, etc. With that, I wish you a great week, and we look forward to seeing you next week on Mortgage Watch. And stay tuned for details about our upcoming teleconference early next week about what you can do to restore your home equity line of credit. Thanks very much and take care.